Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And many market participants yesterday were found surprised by the kind of move unraveled for USDINR. I mean, very interesting move we had on the upside, majorly on the rumored outflows and then some stop losses being triggered. Now, apart from that, there's a lot many things that we have to watch out for this week, namely Gujarat state election results that should be released out this week. Apart from Gujarat state elections, we have the RBI MPC meeting outcome, which will be released on 7th of December. Now, folks, this is something market is keenly watching out for, and a 35 basis point hike is widely discounted by the participants. Even on oil front, there has been good action with oil dropping a little on the possible reduced demand from the still hawkish stance of the Fed, as well as not so much action on the global growth front. So, JK, I'd like to know what's your thought on all this.
Good morning. Risk sentiment took a beating yesterday as players relooked at Friday's jobs data and the strong services PMI released yesterday. And the result was a big profit taking in dollar short sell-off in treasuries. And even as yields were at multi-month lows and as mini meltdown in stocks was also there. We had two surveys of service sector activity in the US S&P Global and Institute of Supply Management, and reports were quite contrasting. S&P Global painted a gloomy picture on the sector with activity continuing to be in contraction territory and the index falling further on a monthly basis from 47.8 to 46.2. In contrast, ISM non-manufacturing PMI report rose from 54.4 previous month to 56.5 in November and beat expectations of 53.3. It also stays well in the expansion territory. So the which one to follow is the debate that market is contemplating. S&P report covers data provided by US companies in the services sector, but the ISM includes the public sector activity as well, thus masking any business trends slowdown, and especially in the private sector activity. S&P coverage is consistent with all the services PMI in other countries, ensuring international comparability. So notwithstanding the above, analysts are still looking at the wage inflation, which doubled on a month-on-month basis in Friday's jobs report. In fact, Larry Summers, the former Treasury Secretary, one who is seen as the best inflation forecaster, voiced concerns that high wage inflation seen in the jobs report meant that Fed will need to increase rates more than what the market was expecting, and even a 6% terminal rate was not out of the reckoning, according to him. As the market bias turned negative, there was more selling in bonds. 10 years spiked from 3.50 to 3.61. Also, the whisper column in Wall Street Journal hinted that if CPI comes stronger next week, Fed could raise rates by 50 basis points in December as well as February. Stock gave up much of last week's gains in partial reaction to ISM report and also none to encouraging corporate news. After Apple, it was the turn of Tesla to announce a cut in production of its cars from Chinese plant. All the major indices in the US lost more than 1.5%. Oil prices slipped, not being able to rally after the G7 cap on Russian exports came into effect. And there has been a staggering fall in natural gas prices yesterday by about 11% based on lesser drawdown from stocks, even as warmer winter weather impacted demand. Energy analysts are projected falling further 20% as supply is expected to outstrip demand in the months ahead. We also had PMI services report from Eurozone and UK. In fact, Eurozone data stream was mixed. PMI services lower, composite index advancing, retail sales weaker, but the investor sentiment as per Sentix index rising for the second month in a row to its highest level since June. UK economy combined soft numbers in manufacturing along with services portends the economy shrinking by 0.4% on a quarter-on-quarter basis. However, investors are now still seeing 89% chance that US central bank will increase interest rates by 50 next week to 4.25, or rather 4.25 to 4.50, with rates peaking at 4.984 by December 2020. In fact, they also expect, by December 2023, they actually expect the rates to decline to 4.574. So despite Fed denials and everything else, the market is still seeing Fed cutting rates next year. So that's very interesting. On the rupee front, as you said, Shikhar, it was a stark underperformance. Rather, I would, see the rupee was underperforming against almost all currencies in yesterday's trading, and that stood out. For marketplace, the day started with anticipation that rupee would catch up with other Asian and EMPS, particularly the smart recovery in Chinese yuan. But right from the word go, we saw only import and other corporate buying. And after break of 81.60, stop losses did kick in with a move to 81.80 before some intervention from RBI through futures and spot market was seen. It was simply a case of short-term market positioning being squeezed out, and no fresh particular fundamental trigger has been there. In fact, India's PMI on services as well as composite index were higher and well in the expansion territory, which compares, far better than most other nations. But investors are obviously not looking at those aspects right now. Rupees weakness can be gauged from the fact that while the broad EM currency index has rallied over 5% since the US CPI data which last month, which came lower, INR is less than 1.5% from its historic close. That said, I do expect RBI's renewed action from the selling side today as we near the 82 levels, both from a stability point of view as well as the inflation perspective. So any fresh DXY strength could influence rupee towards 82.25, but profit taking in cross INRs like Euro INR and GBP INR should limit the upside for the dollar, at least until the RBI and later US events which are key for the markets. The 1 year forward premium fell further to 1.8% on annualized basis. Also, we even as the World Cup football moves into the quarterfinal stage, we had the start of the semi-final for the Indian general election in 2024. The exit polls for Gujarat and Himachal Pradesh state assembly results, exit polls were seen yesterday, and we saw the ruling party, in fact, strengthening its hold in these two states. Of course, the final results come on 8th December. If we do have political stability continuing, that's one definite medium-term positive for the rupee. But in the short term, we are faced with a lot of volatility. Thank you.
Okay, JK, I get there's a lot of activity in the markets and good data releases, but we've also seen yields at multi-month lows, as you mentioned, which is quite interesting. The market sentiments had some dent, as you mentioned, on majorly on the backdrop of wage inflation being on the higher side, which also pushed the kind of expectations by the Fed on a rate hike side a bit on the higher side. But it was quite interesting to also hear that even though there's a lot of people talking about a higher terminal rate, there are few market participants talking about possible rate cuts even by December 23. This is quite interesting, folks. And as JK mentioned, the rupee mentioned USD INR move was quite surprising, and it was not much in sync with the EMFX. So as JK mentioned, there is a possible renewed action from the central bank, which we can see. But one of the things I really liked about the commentary was the analogy between the World Cup as well as our Indian elections. I mean, guys, we are, yes, definitely entering into semi-finals of Indian election, and there's going to be a lot of focus and energy by the folks out there, and definitely the kind of interest people have seen in World Cup, we'll see it in Indian elections as well. So be prepared. Next year is going to be a lot more fun for everyone with respect to kind of updates we'll be receiving. That's it for today, folks. We'll be coming up again tomorrow with another round of updates. Thank you so much for listening.